Lucy MacDonald is Chief Investment Officer at RCM in London. She oversees around $8 billion in global equities. Lucy, first of all, thank you very much for joining us. Well, it's so uncertain at the moment. There's so much volatility. How do you decide what to invest in and how do you manage the risk?
Well, you're right. There is a tremendous amount of volatility, and managing that is a key part of what we're doing every day. And looking to find areas of certainty in a very uncertain world is something that we're doing. And an increasingly interesting and attractive thing for us is income and dividend income. And when you're looking at the yields that are available on some of the equities that you can buy, they look that much more attractive when you look at the bonds that have got the similar yields, and the actual risk of losing your money in those bonds compared to looking at the equities. And so I think for us, that is one thing that we've really begun to put more emphasis on since the financial crisis 2 years ago, is really looking at that yield. Because if you think that you're not going to get a huge amount of nominal return out of your markets, the part that's made up by the yield is going to be that much more.
I wanted to get you to talk us through your top 3 picks. I gather you're interested in healthcare. Is that one of them? Yeah.
I mean, healthcare is an area we've been overweight now for a couple of years. Mm-hmm. And it is beginning to work quite nicely. What we like about it is valuation, yield, cash flow, the lack of exposure to cyclical elements, which is particularly important at the moment, but also quite a good dispersion of the different sort of companies where you can find yield or you can find growth, and you get some pretty good returns if you pick right. But you do need to pick right.
I was going to say, are there any particular companies?
Well, of the ones that we own, Celgene is one of our favourites, and that makes a blood cancer drug, which is already growing quite fast, called Revlimid, but looks as if it's going to get an additional approval in Europe, which would allow it to extend its growth further. So that, to us, looks like a little bit of a growth in an uncertain world.
What about tech stocks? Are you interested in any of them?
Yes, again, tech is a very dispersed and differentiated sector, and so you can find very secure income-generating tech stocks now. Increasingly, they are beginning to pay dividends. And then at the other end, you can find some quite exciting growth companies. I think for tech as a whole, you mustn't forget the fact that it is cyclical. And we are definitely seeing some slowdown in IT spending, probably going into next year. But compared to other areas, I think we think that corporate spending generally should be holding up quite well because the balance sheets in the corporate sector are quite strong.
What about consumer stocks? Or are you interested in any of those, and if so, which ones?
Yeah, the consumer stocks, we are tending to be a bit more cautious, particularly in the cyclical end. The consumer cyclicals have done very well at a time when you wouldn't have thought they would. And they have been re-rated, so that actually they look one of the most expensive sectors across all markets. And that causes us to be a little bit cautious at a time when you've had some one-off boosts to consumption, particularly in the US, which are now probably not going to be there. And that means that you might get a little bit more weakness. And we've begun to see that with Best Buy. We've begun to see that in some of the consumer electronics already, but I think we might see it a bit more widely.
What about sort of your top 3 companies? If you could name them, what would they be?
Well, as I mentioned, yield is something that we are looking at. Another large holding that we have is Royal Dutch Shell, which we've had in the portfolios this year, and that's been very, very steady, sort of 5% yield, but also has a new project coming online. It's been spending a lot of capex, and it has a new gas liquids called Pearl, and that's coming online this year, this is about 2012. Which will mean an increase in cash flow. And so the capex should be at a level where it's now flattening out, and you begin to get some benefit from the investment they've been making. So that should be quite a nice move for next year, and not too dependent on the oil price itself, which is very uncertain.